Right. Let's unpack this. Today, we are doing a deep dive into Warren Buffett's financial journey, but we're not just going to rehash the usual investment advice you hear all the time. Our mission here is really to look at his wealth growth chronologically, sort of like a year-by-year financial diary. We want to figure out not just how he made the money, but crucially, when the key lessons were learned and how that compounding effect really, truly takes off. And honestly, the single most stunning thing we found in the source material is this. Get this. 99% of his total net worth came after he turned 50.
Wow.
And 98% after age 65. Think about that. His first million took him like 30 years of grinding.
Right.
But then the jump from $100 million to $1 billion, just 5 years. Between age 50 and 55, that acceleration,
Right.
that's what we really need to understand today.
It's absolutely fascinating. And what we're looking at is really a study in patience. I mean, incredible patience, both financially and emotionally. If you're feeling like you're stuck in that long, slow preparation phase right now, well, this deep dive is definitely for you. We're going to trace the specific early moves, the public mistakes he made, even the long stretches where his returns weren't actually beating the market, because all of that was necessary groundwork for that exponential growth later on.
Yeah.
We want to connect those decisions he made way back then to things you can maybe think about doing today.
Yeah, absolutely. To really get that 99% that came later, we have to start with the first 1%, right? Built way back. We're talking 1936. Buffett's 6 years old, selling chiclets door to door. Yeah. Then he scales up, adds Coca-Cola to his little route, makes his first $10. It already shows that core lesson. Start small, prove it works, and then scale up. Build those multiple income streams.
And it's kind of amazing how quickly these big lessons seem to hit him. Like at age 10, this is 1940, he buys his first stock. City Service Preferred, buys it for $38 a share, sells pretty quickly for $40. A small profit. Looks like a win.
Right, a classic beginner move, yeah. But the real lesson, the painful one, came later when that same stock shot up to $200.
Ouch.
Exactly. He learned the hard way, didn't he? That selling your winners too early can be, well, incredibly costly. That idea of holding quality long term, that seems to have clicked when he was barely a teenager.
It really does. And you see the other habit forming immediately, reinvesting profits aggressively. By age 14, he takes his paper route money, buys a 40-acre farm in Nebraska.
A farm at 14?
Yeah. It wasn't about spending the money. It was about capital allocation. Decades before anyone really knew who he was. Always taking the earned cash and putting it right back into something that generates more income.
So the path was kind of set early on, but, one of the biggest turning points was actually a rejection. Harvard said no in 1949. And that perceived failure actually led him to Columbia. And that's where he found Benjamin Graham.
That's such a great example of how sometimes the detour is actually the right path. It's crucial because after Columbia in 1954, he deliberately chose to go work for Graham himself at Graham Neiman Corp.
Right, the father of value investing.
Exactly. And get this, he took a pretty low salary for the time, just $12,000 a year, specifically to get that direct mentorship. The lesson there is so powerful, isn't it? Be willing to sacrifice immediate income, maybe even take a pay cut, if it means learning directly from the best in your field. That education is worth way more long-term.
And you see that discipline mirrored in his personal finances, too. Early 50s, he's married, has a kid, but he's still saving 50%, maybe more, of his income.
50%? That's intense.
It really is. We talk so much about finding the right investments, but the sources really highlight just how critical it is to live below your means. Without that high savings rate early on, even the best strategy doesn't have enough fuel to compound exponentially later.
Okay, so as he moves into his late 20s, things get a bit more strategic, maybe complex.
Yeah, like in 1956, the numbers show his net worth actually went down by about 65%, from $28,000 to around $9,800. Now, if you just saw that figure in isolation today, you'd probably think, okay, he blew it. But that wasn't what was happening, was it?
No, not at all. And that's a really important point for anyone starting out or maybe facing a temporary dip. That was strategic repositioning. Graham Newman was dissolving, so Buffett returned capital to his investors there, specifically so he could launch his own fund, the Buffett Partnership Ltd.
Oh, okay.
So sometimes what looks like a step back, a decline on paper, is actually just setting up a much better structure for the long haul. Take a small hit now for much bigger gains later.
And that new structure clearly paid off. By 1960, he's 30 years old, and he hits that goal he apparently set when he was just 8. He became a millionaire.
Wow.
Managing over $7 million in his partnership by then. It just shows. Clear goals plus disciplined execution.
Yeah.
It works.
And what's really interesting here is how he even used his mistakes, arguably. In 1965, he gets control of Berkshire Hathaway. Now, he famously called the textile business itself his first major mistake.
Right. The actual operations were bleeding cash.
Exactly. But the structure, the corporate shell of Berkshire Hathaway, that mistake became the platform for his entire empire.
Can you unpack that a bit? How does a mistake become a platform? That sounds a little counterintuitive.
Well, think about it this way. If he hadn't taken control of that existing public company, Berkshire, every time he wanted to redeploy capital from one investment to another, he might have had to liquidate things, pay huge taxes, start over. Berkshire Hathaway, the corporate entity, gave him what's called permanent capital, money he could allocate and reallocate internally, tax efficiently, without constantly having to distribute it back to partners.
Okay, that makes sense. So the textile mill was the bad part, but owning the public company vehicle itself, that was the genius move, even if accidental at first.
Precisely. It gave him incredible flexibility and tax advantages. And that structural freedom really set the stage for the huge philosophical shift around 1972. This is where Charlie Munger's influence really comes into play, and they buy sCandies for $25 million.
Right, this is the big turning point, moving away completely from his old Graham strategy, the cigar butt investing.
Yeah, for anyone not familiar, cigar butts were Ben Graham's idea of finding companies that were, like, statistically super cheap, maybe troubled, but had one last puff of value left in them.
So really deep bargain hunting.
Exactly. But with C's, influenced by Munger, Buffett starts shifting towards paying, well, maybe not bargain prices, but fair prices for exceptional businesses. Businesses with real brand loyalty, pricing power, durable competitive advantages.
sCandies was the test case for that new philosophy.
It absolutely was. And that $25 million initial investment, it's generated something like over $2 billion in earnings since then.
Okay.
That's the lesson right there. Quality over just cheapness. Find businesses that can grow and compound value internally without needing constant new capital injections.
Okay, so if the first couple of decades were about building the foundation and refining the philosophy, the 1970s seemed like the real trial by fire.
Definitely.
1974, you've got the oil crisis, a deep recession, and Buffett has his worst year ever in percentage terms, a huge 44% drop. His net worth goes from about $43 million down to $19 million.
Imagine seeing almost half your wealth disappear in a year. That's where the emotional fortitude really gets tested.
So what did he do? Did he panic? Sell?
That's the amazing part. His reaction is legendary. It's one thing to read the saying, be fearful when others are greedy and greedy when others are fearful. It's another thing entirely to live it when 44% of your money has vanished. But he famously described himself then as feeling like an oversexed guy in a harem because there were so many bargains around.
That's quite the image.
Isn't it? But it shows his mindset. He started buying aggressively. Companies like the Washington Post, Geico. Buying when public fear was at its absolute peak, that psychological hurdle is enormous.
And results.
Almost immediate and spectacular.
Yep.
In 1975, the very next year, his portfolio jumps 84%. That courage in 74, buying when everyone else was dumping stocks, it generated truly life-changing returns very quickly.
What was the total gain from that 74 low point?
From the bottom in 74 to 1977, so just 3 years, his net worth went from $19 million up to $67 million, a 350% gain.
Wow. Just wow.
But this period also highlights another kind of courage, the courage to stop. Remember back in 1969?
Before the 74 crisis.
Yeah, he actually dissolved his incredibly successful partnership, returned about $100 million to his investors. Why? Because he felt the market was getting frothy, too speculative, and he couldn't find anything cheap enough to meet his standards.
Wait, he just gave back $100 million, closed up shop when he was winning. That sounds like leaving a huge amount of money or potential fees on the table.
It does, doesn't it?
Yeah.
But that's the discipline. He prioritized sticking to his principles and preserving capital over chasing the last few percentage points in a market he thought was dangerous. He was willing to basically sit out the party. That tells you a lot about his long-term thinking. Protecting the downside, staying rational, was more important than maximizing short-term gains or fees.
That kind of deep conviction, maybe that's what enables the crazy acceleration we talk about at the start. Let's go back to those numbers because they are just staggering. 50 years to hit $100 million by 1980, age 50. Then only 5 more years to hit $1 billion by 1985. Age 55. How does that happen so fast?
It's the beautiful and sometimes cruel math of compounding, isn't it? When your starting base is small, say $1 million, even a fantastic 25% return is only $250,000. But when your base grows to $100 million, that same 25% return adds $25 million in a single year. By the time Buffett hit 50, his investment base was so large that the annual returns he was generating started dwarfing all the money he'd saved and invested in the previous decades combined.
The snowball just got massive.
Exactly. The flywheel was finally spinning fast enough and was big enough that external bumps, even big ones like Black Monday in 1987.
Right, the worst single stock market crash day in history.
Yeah. It barely mattered to his long-term trajectory. He still finished 1987 up 50% for the full year. Short-term volatility just becomes noise when your capital base is huge and your time frame is, well, effectively infinite. So this brings us to the later stages, the final chapter maybe. And here the test isn't so much about fear, but maybe about discipline against public opinion and the willingness to evolve, particularly around the dot-com bubble.
Oh yeah, that period was a huge public test for him. From roughly 1999 to 2002, it must have been incredibly tough emotionally. In 1999, his net worth basically went nowhere, stayed flat around $36 billion. Meanwhile, the NASDAQ index was up, what, 86%?
Insane numbers.
And he was getting absolutely hammered in the press, those famous What's Wrong, Warren articles, people saying he'd lost his touch, didn't understand the new economy, all because he refused to buy tech stocks he felt he didn't understand, and that looked wildly overpriced.
Imagine the pressure. Everyone around you is seemingly getting rich overnight in these dot-com stocks, and you're sitting it out, looking like a relic. That takes an almost superhuman level of discipline and mastery over FOMO, the fear of missing out.
He just stuck to his knitting, basically.
He did. He was willing to underperform, even look foolish short-term, to stick to his core principles of only investing in businesses he understood, and that met his valuation criteria. And the vindication, when it came, was pretty swift and brutal for everyone else.
Right. By 2002, the bubble had burst spectacularly. Those same tech stocks were down 70, 80% or more. The people who mocked him got crushed.
And Berkshire. It weathered the storm relatively unscathed, declined only slightly, then recovered. The lesson there is stark, isn't it? Never let crowd psychology or media pressure force you out of your rational framework.
But what's also amazing in this later period is his capacity to change his mind, to evolve. After decades of success with a certain approach.
You mean avoiding tech?
Exactly. For 50 years, he famously avoided technology stocks, said he didn't understand them. Then, at age 86, in 2016, he makes this massive bet on Apple, which turned out to be one of his most profitable investments ever.
That really shows intellectual humility, doesn't it? Which is maybe just as important as discipline. He didn't let his past dances prevent him from seeing a new reality. He eventually saw Apple not just as a tech company, but as an incredibly powerful consumer brand, like Coca-Cola or sCandies, but with technology. He recognized its moat.
Right, the moat being that competitive advantage. For Apple, it's the ecosystem, the brand loyalty.
Exactly. That pricing power, the customer lock-in. He realized it fit his evolved framework of quality businesses, even though it was in a sector he'd previously shunned. It shows you're never too old to learn or adapt your thinking.
So then we get to the more recent crises, 2008.
2008, he played the classic Buffett playbook perfectly. Maximum fear and panic after Lehman Brothers collapsed. What does he do? Steps in with $5 billion for Goldman Sachs on very favorable terms.
Pure greedy when others are fearful.
Textbook. But then, fast forward to 2020 and the COVID crash. The story's a bit different, isn't it?
Yeah, the sources point this out. He seemed much more cautious. He actually sold off his airline stocks near the bottom, taking a big loss.
Right.
And he largely sat out the incredibly sharp market recovery that followed, building up a record cash pile instead. He got some criticism for being maybe too cautious that time.
That's a fair point. And it shows that even legends don't get every call right. Maybe the sheer size of Berkshire now makes it harder to be nimble. Or maybe, as he approached his final years, capital preservation became even more paramount.
Could be. Too much caution definitely cost Berkshire potentially billions in missed gains during that 2020 rebound.
It did. But perhaps we can also view that massive cash hoard, now reportedly around $325 billion, through a different lens. Succession planning.
Ah, interesting. How so?
Well, he's trimming his biggest winner in concentration risk, which is Apple. And he's building this enormous pile of cash. You could argue that's the ultimate act of setting up his successor, Greg Abel. He's handing over maximum flexibility, maximum dry powder to make his own mark, rather than a portfolio locked into Warren's final bets. The last lesson might be, build something designed to outlive you and empower the next generation. Hashtag tag not outro.
So, after walking through almost a century of financial history here, What's the big takeaway for you, the listener? I mean, it seems crystal clear that the hard part, the really slow grinding part, was the preparation. The decades of saving, learning from mistakes, studying Graham, having the guts to buy in 74, the patience during the dot-com bubble,
Right.
the truly spectacular financial results, that crazy acceleration that really only kicked in super late once the foundation was massive enough for compounding to work its magic geometrically.
Yeah, if we had to boil it down to maybe three core takeaways from this whole journey, what would they be? I'd say first, time is your greatest asset. You saw it took decades to build a base. 99% of the wealth came late. So focus on starting early, being consistent, even if the amount seems small at first. Let compounding work for you over decades.
Okay, time is number one. What's two?
Second, crisis equals opportunity, but you can only seize that opportunity if you're prepared. That means building up cash, your dry powder, during the good times, during the bubbly markets. You need the financial and psychological reserves ready when everyone else is panicking.
Makes sense. Build the war chest when the sun is shining. And third,
Third, quality trumps price, eventually. Emulate that philosophical shift he made. Don't just hunt for bargains for cigar butts. Focus on identifying and paying a fair price for truly exceptional businesses, the ones with durable competitive advantages, the moats that can compound value internally for years and years. Think Seas, Coke, Apple.
time, crisis, quality. Got it. So that leads us to our final provocative thought for you to chew on. Think about that huge gap, that lag time between the decades of effort Buffett put in and when the really massive results showed up. He spent, what, 65 years diligently preparing, saving, learning, positioning for gains that mostly materialized in his last 25 years. So the question for you is, what habits are you building today in your finances, your career, maybe just in learning where, deep down, the really big payoff might not come for 10, 20, even 30 years? Are you willing to embrace that long incubation period and trust the process?